Hey guys, Akil here. Welcome back to the Trading Coach Podcast. Today we're going to be talking about top-down analysis. We're going to go through some of the pros and cons of using it, and I'm going to share my opinion on what are the right combinations to use if you are going to use this technique. Today's episode comes from a conversation I've been having in the DMs on Instagram land, and if you're new, right, don't feel shy about asking me questions. I'm on Instagram, I am on Twitter, I'm on X. Not the drug. It sounds weird yelling that very loudly. I'm not on that type of drug at least. But don't be shy about reaching out, right? If you have a question, ask it, right? Best case scenario is you get an answer. Worst case scenario is you don't get an answer, you don't get a response, which leaves you in the exact same place you were in before you decided whether to ask it or not. So it's a risk-free trade. And today's question really started with a simple ask. It was a trader basically saying, hey, what do you think about the pound yen? And this came after my weekly Trading Edge video. I didn't cover the pound yen in this Trading Edge video, but many of you guys watch it and are looking at certain pairs. And when they don't make the cut, you usually ask my opinion. And my usual response to this question is, hey, I can't really answer that question for you because my perspective all depends on what time frame you're looking at, right? For example, my perspective on a monthly chart is different than my perspective on an hourly chart. So you got to give me a little bit more details about what specifically you have questions about or what time frame you want me to address it on. And the trader responded, said, thanks for the response. I'm doing some top-down analysis on the pound yen, starting on the monthly time frame and going down to the 4-hour time frame. What is your bias? And this kind of sparked the conversation on top-down analysis and big jumps in the market. And I told this trader my bias. But then I also told him that, hey, understand that although I have a bullish bias on the monthly, that has nothing to do with my bias on the 4-hour, as I see them as two completely different stories that don't necessarily have anything to do with each other, right? Maybe one's like a spin-off, but it's not necessarily part of the other story. And before we kind of dig into that, I want to talk to you guys about what top-down analysis is, especially for the newer traders, right? Top-down analysis is the process of using multiple time frames to kind of form a confirmation bias about the market, right? So there are some techniques, especially mechanical techniques, or I'm still working on a daily technique where you can literally just hop into one time frame. Advanced patterns are like that for me as well, where I don't need any extra analysis. I just kind of hop into the chart and I get everything I need from that one chart. But in many cases, when you're doing technical analysis as a price action trader, you want to put yourself in perspective, you want to put yourself in position where you're either gaining a perspective from a higher time frame or you're getting a finer look from a lower time frame. So gaining perspective from a higher time frame is like kind of zooming out, right? Taking a Tesla rocket ship into space and looking at the world from a big picture view to kind of see what is happening bigger picture, right? What are we doing to our ozone layer? Why is this country on fire? All this fun stuff, right? A lower time frame would be equivalent of like going into a microscope, right? Once you decide what you want to isolate your attention on, then you're sliding that thing under the microscope and you're getting kind of a closer look at what's actually happening. So typically, and this is how we teach our traders at Tier 1, you're using a 2 or 3 time frame combination. For example purposes, let's say we're using a 3 time frame combination. The higher time frame lets you set your bias. Like, so I look at this higher time frame, I see that we are at structure, we are in the middle of no man's land, we are bullish, we are bearish, right? What is the overall bias of the market? Let's say bullish for this example. There's a trading time frame in the middle, right, where you do other stuff on. But the lower time frame, right, putting it under the microscope, that's where once we've decided that we want to be bullish and that we have what we need on our trading time frame in order to put ourselves in that bullish position, now we're looking under the microscope to see, like, is there any type of last clue? Is there a specific entry reason that can give me kind of a quicker in on the lower time frame? And that's how the 2 or 3 combinations work together. So you can see it's really good. And when you're using that process, what you're doing with the higher time frame is you're forming a confirmation bias. Whatever bias you form, right, bullish or bearish on the higher time frame, is what you want to carry on to your lower time frame. That way you're locked into the same thing. But understand, confirmation biases can be negative as well. And this is something that happens to many newer traders. This happened to me earlier on in my career as well. A good example is this, right? So early on in my trading career, I used to watch the news a lot, right? I had 4 TVs. I was watching CNBC. I was watching Bloomberg, Reuters, right? All the stuff you can think about, right? And what I would do is I would listen to these pundits, these important pundits in my perspective, and basically I would form biases based off what they said. So if everyone was saying you gotta sell the dollar, sell the dollar, sell the dollar, interest rates are coming, sell the dollar, I would look at the chart and I would only want to sell the dollar. It could be the biggest, bluntest, bullish signal in the world, but I'm like, Aaron says that we should be selling the dollar, so we should probably sell it, right? That is a negative confirmation bias, right? My mind was made up that I wanted to sell, which is good. It's good that I have my mind made up, but it was made up for bad reasons, right? And we can do this with an improper confirmation bias as well. So going back to the example that our trader spoke about, where we're going from the monthly to the 4-hour, right? The monthly to the 4-hour is a massive jump. So let's say the monthly is our higher time frame, right? We're forming our bias, we're looking at the euro dollar, and we're saying, buy the euro dollar, right? The monthly says that we are in a bullish trend. We should be buying. Well, when we go down to the 4-hour, right, we may have a completely different perspective on the 4-hour, right? The 4-hour, for example, may be in a very bearish setup, yet our mind is saying buy. I'm looking at some old RM in my mind. Keeps telling me buy, right? So, that was pretty good. Some old R&B stuff, right? But we are in this position where we're so stuck in our decision that we only want to trade in that certain way. And again, normally that would be good, but the fact of the matter is there is such a big gap between the weekly and the 4-hour that we have to understand that the 4-hour, again, really has nothing to do with the weekly. It is a completely different story. So like, here's an example, right? I'm looking at, let me go to a chart right now, euro dollar, for example. That's the most popular one. I'm on a weekly chart right now, clicking away, and I'm looking at the most recent candle, and I'm looking at the ATR. The ATR is the average true range, right? And the average true range of the most recent candle I have on the euro dollar is it's 138 pips, meaning that within that week, week by week, the average movement, right, up and down range of the candlesticks moves 138 pips. This is called 140 to make the math simple. Now let's go down to a 4-hour chart. I'm gonna look at the most recent candle. ATR is 17, right? 17, which is super crazy low, but it is 17, right? So that means, right, on an average 4-hour candle, price moves 17 pips. On an average weekly candle, price moves 140 pips. I got to whip my calculator out real quick and do this. 140 divided by 17 equals 8, right? So we can have 1 week on the chart that is, on a weekly chart, for example, that is a bearish candle, right? And a bearish candle doesn't mean a bearish trend. It just means a little correction. It could easily just be the first part of a pullback, right? Literally one candle. And that's going to be 8+ candles on the 4-hour. 8+ candles on the 4-hour can be a completely different trend in its own right? Do you see how the gap is too wide to kind of look at them together? In my opinion, we're just getting two completely different stories, and we don't want to be locked into, if we have a no-brainer bearish trade on the 4-hour that can extend for 16 days, that can easily be 2 small candles on a weekly chart, which has nothing to do with the overall trend. So we can easily put ourselves in positions where, one, we are keeping ourselves out of positions that we should be because of this false bias, or maybe not false bias, but this unrelated bias. Or two, we're taking trades in the wrong direction because we feel like we have to be in a certain direction in the market because of a bigger time frame. So here's my opinion on kind of how I think we should set up our higher time frame and our trading time frames and our lower time frames. I guess our top-down analysis kind of procedure or process. And understand, right, it doesn't matter what time frames you trade. You can literally go from any time frame. Just enter a number, you can find a time frame from it. But with that being said, there are some kind of, I don't want to say industry standards, but there are some popular ones, more popular ones than others. And I'll kind of walk you through what they are, right? The biggest is probably the monthly, which is, for me, it's not a trading time frame. That's when you're more of a long-term investor, right? Trading is kind of short in, out. I don't think the monthly gives you a lot of perspective unless you're a really long-term trader that's looking to hold things for months and years. But again, in that perspective, you're more of a short-term investor, in my opinion. But let's start with the monthly as being the highest. Down from the monthly is going to be the weekly. After the weekly is going to be the daily. After the daily, right, going by popularity, is going to be the 4 hour. After the 4 hour, it goes to 1 hour. And then you have, like, I'll throw the 30-minute in there. I don't really like the 30-minute, but I'll throw the 30-minute in there, the 15, the 5, and then honestly, under the 5, right? We always make fun of traders going down to the 1 minute chart. We laugh, but seriously, don't ever go there. Don't ever go to, promise me, don't you ever go to the 1 minute chart. It is trouble. I promise you that. But under the 5 minute chart, that's when you want to go to different kind of type of charts, like a tick chart or a range bar chart. Those are going to be your best options. So if we're looking at kind of higher, lower time frame combinations, I think a good one is monthly and weekly. I think the weekly will give you a nice lower time frame for the monthly. If you want to go one more lower, I can get on board with the daily, saying, hey, monthly higher, daily lower. It's a little bit of a reach, but I can get down with that. If you're going to be someone that is trading off of the 4 hour, for example, I think the daily is a good higher time frame. I think an hourly is a good lower time frame. If you're trading off the hourly, I think either a 4 hour or a daily time frame is a good higher time frame for the hourly chart. And if you're trading off, let's say, like a 15 or a 5 minute, I think an hourly is a good higher time frame, maybe a 4 hour at max. But you can see that I'm not jumping from 5 minute to daily. I'm not jumping from 1 hour to monthly. Those extremes are just too big. Again, technically it's the same chart, it's the same, asset that you're looking at, but you're dealing with two completely different stories. I'm trying to think of a book example. We're looking at kind of like Star Wars, for example. You have the main Star Wars movies, but then you have all these little spin-offs of these minor characters where it's like, yeah, it's technically in the same category, but one doesn't really have anything to do with the other one. And I think you can just get into a lot of trouble when you're trying to make trading decisions off of that. So, let me know what you guys think in the comments section below. What is your favorite combination? What do you think about top-down analysis? If you think we should be making big jumps or keeping it together, I'd love to hear your input. And that way our newer traders and traders that are pondering this question can look at it and kind of get some advice as well. And of course, always before you leave, do me a favor, hit that like button, rate and review if you haven't done so already. It's the best way to help us grow the podcast, along with sharing this with your social community. And until next time, plan your trade, trade your plan, keep the questions coming, and I will keep the episodes coming. Take care.